Are rising interest rates affecting your finances? You're not alone. Let's see exactly how these rising interest rates impact your wallet and loans, so you can shelter your money wisely. Though Fed hikes mainly affect borrowers, they also impact savers positively. In this video, let's explore what rising rates mean for your money situation. Why the Federal Reserve raises rates. The Federal Reserve raises or lowers interest rates mainly to keep the economy stable. The Fed watches two key things: inflation and recession risk. The Fed aims to maintain inflation around 2%, but inflation recently hit 7.1% in December 2022. So the Fed is hiking rates, which often slows consumer spending and cools inflation. More rate increases are expected. However, slowing inflation also risks recession, when unemployment goes up and production declines for months. People then cut spending, so the Fed may lower rates to spur spending again. It's a balance for the Fed. Raising rates slows inflation but could trigger recession. Cutting rates may stimulate the economy but risks igniting inflation. Some criticize keeping rates too low for too long after the pandemic recession fueled current high inflation. How rate hikes flow down to consumer loans. When the Fed raises its benchmark federal funds rate, the ripple effects spread across financial markets and impact borrowing costs economy-wide. Although the Fed does not directly control consumer loan rates, its rate hikes influence the prime rate and yields on Treasury securities that lenders use to price loans. Paying down credit card debt. Since most credit cards have variable rates, the Federal Reserve's rapid pace of rate hikes has already translated to sharply higher interest charges for cardholders. The average credit card rate has surpassed 19% compared to 16% at the start of 2022. This jump significantly increases interest costs at a time when households face rising prices for necessities like food, energy, and shelter. If you carry balances from month to month, focus on paying down high-interest credit card debt. Every dollar you save on credit card interest is one less dollar wasted that could have gone towards meeting expenses or growing savings. Explore consolidating and transferring balances to a lower rate card. See if you qualify for a 0% APR balance transfer offer to stop interest for 12 to 15 months while you pay down principal. Avoid rack up more credit card debt. With variable rates marching higher, now is certainly not the ideal time to rely on credit cards to finance purchases. Take steps to curb spending and free up cash flow to weather rising interest expenses. Track where every dollar is going each month to identify waste. Make necessary lifestyle adjustments to rein in expenses amid high inflation. Build an emergency fund over time so you can lean less on credit cards during unexpected crises. Consider alternatives like buy now, pay later plans, which offer interest-free installment payments without ding to your credit. While convenient, use BNPL responsibly because late fees can add up. Above all, develop healthy money management habits by living below your means and using cash or debit for most purchases. The less you need to borrow, the less vulnerable you are to shifting rates. Student loan refinancing. Considerations. Over 43 million Americans carry nearly $1.6 trillion in student loan debt. Federal student loan payments and interest accrual have been paused since March 2020, providing temporary relief. However, payments and interest charges are set to resume in June 2023 unless broad student loan forgiveness is enacted. Meanwhile, the 7% interest rate on new undergraduate federal direct loans is the highest since 2009. Given rising rates across lending markets, student loan refinancing rates are also trending higher compared to 2021's rock bottom levels. Still, refinancing rates remain near historical lows. If you have good credit, 690 plus score, you could reduce your student loan interest rate by refinancing, which saves money over the loan repayment period. New auto loan and mortgage rates. Unlike credit card debt, most auto loans and mortgages have fixed interest rates locked in for the entire repayment period. So existing borrowers with fixed-rate loans are shielded from the immediate impact of the Federal Reserve's policy moves. You pay the same predetermined rate until the loan is paid off, regardless of how market rates trend. However, rising rates do hit people taking out new loans for big-ticket items like cars and homes, which are sensitive to rate shifts. For example, the average interest rate on 5-year new car loans has climbed from 4.5% in January 2022 to 6.3% in November 2022. Meanwhile, rates for 30-year fixed mortgages have spiked from 3.2% to 6.6% over the same period. This rapid rate growth makes large loans much more expensive. Before pulling the trigger, weigh rate rise impact on affordability and your purchasing power. Try stretching loan terms to 7 years for car loans and opt for 15-year mortgages to keep payments manageable if your budget is tight. The shorter repayment timeline also limits interest costs relative to longer 30-year mortgages. Avoid adjustable rate mortgages and buy only when you can truly afford payments if rates rise further. Don't take on larger loans than needed. For cars, purchase quality used vehicles outright in cash without financing to dodge rate risk. Save diligently for larger down payments to keep loan amounts low. Implications for investing strategy. Rising interest rates have important implications for investment portfolio returns and asset allocation strategy. As rates climb, bond prices decline, and bond fund share values drop because investors can get similar yields from newly issued bonds paying higher coupons. This dynamic has fueled sharp declines across nearly all bond fund categories in 2022. Add bonds slowly over the next year as higher yields start offsetting price drops. Short and intermediate-term bond funds are preferable to protect against further losses when rates peak. This allows reinvesting interest income at higher prevailing rates. Boost your savings rate. As rates increase, shop around since banks now offer far higher yields on savings vehicles to attract deposits. Boost emergency fund contributions and capitalize on spiking returns rather than leaving cash idle. Shelter your budget wisely. The Fed's rate hikes reach across the economy, influencing borrowing costs and savings returns. Shelter your budget by aggressively building emergency savings, eliminating expensive debt, and growing income. Spend carefully and dodge unneeded loans as rates rise. Staying prepared, saving proactively, and making smart money moves helps you ride out turbulence from policy changes. So, how can you use this information about rising interest rates to take positive control of your personal financial situation? What specific actions will you take? Let me know in the comments section. If you liked this video, be sure to like and subscribe to Digital Financial Freedom for more videos related to financial and videos that empower people on their journeys towards financial freedom.